Okay, so in today's Zoffee, we're talking to Ed Hurst, who's an economist at the University of Houston, and we're going to be talking about U.S. shale basin and the health of the industry and where it's been and where it's going in the next little while. So welcome to the Zoffee, Ed.
Thank you.
Now, over the years that I've interviewed you, you have made the point over and over again that the shale basins are high-cost producers, they are marginal barrels, and a lot of them, in fact, maybe most of them, have been losing money since 2008 when the fracking and the shale basins really got going. So maybe give us, your take on that.
Sure. It's easy to make money in a shale basin if you're buying in at really cheap prices. And those kind of went away after 2006, 2007, as the Bakken developed and acreage prices, really kind of ramped up. And the oil basins are, in essence, trailing behind the natural gas basins in the U.S. The low-cost gas basins are the ones that are attracting capital and have gone on. And the granddaddy of them all, the Barnett, has had one rig working this past year, and before that, actually didn't have a rig at all for a couple of years. Because the rock just requires a higher price for folks to extract the gas profitably. The U.S. shale basins, going back, to 2012. All had break-evens above $40 a barrel. That was pretty expensive. Now, over the years, things have become a lot better, and technology and better practices have brought down the break-evens, for example, in the Permian tremendously. But still, at $40 a barrel at the wellhead, these guys are going to have a really difficult time.
Ed, a couple of years ago, IHS Market did a study of this, and they have a graph, which I've got somewhere on my computer, and it shows that at 1/3 of the U.S. shale producers, doesn't talk about volume, but 1/3 of the producers needed a break-even of $60 at that point, $60 or higher. And it seems like even while some of the producers, the more efficient ones or the ones who were high grading, the ones that had a better resource, were driving down their costs, there still were a significant percentage of producers that weren't able to do that.
Yeah, that's an average number, and certainly there's some who can produce at $20 a barrel and make money. I've seen the numbers, I've seen the wells, but most of them can't. A lot of the development in the Permian was driven by private equity, and the economics of the private equity model are different. You go to the first page of your microeconomics text, which I'm sure all of you can remember, and the first discussion is about moral hazard. And so the private equity guys had made a bunch of money. They were getting their pension funds and endowments to reinvest and re-up with them, even those who failed essentially in 2008. And so they kept throwing money at these shale plays, bidding up the acreage to fantastic amounts, $55,000, $65,000, $90,000 an acre undeveloped. And sure, the Permian's got some tremendous geology, a mile deep of hydrocarbon-bearing rock. It's just difficult to continue to make money at these rates. They were throwing so much money at it. At one point, 155 PE-backed companies in the Permian. I think today the number is half of that. But the dynamics were such that the cost of capital was actually negative. The PE sponsors would not get paid their fees unless they deployed the capital. And so they continually bid up the cost of their acreage.
Ed, I heard it described by an American investor this way. He said, we knew going in that that this was high cost oil production, but we made a rational bet that over time, the American ingenuity, American innovation would develop new technology, develop new processes, and drive down the cost per barrel to the point where some or many of these producers would be economic. And he explained that as the driving force behind all of this private capital, basically Wall Street propping up the shale basin for all these years. What's your take on that?
Well, that wasn't a rational bet. That's a rationalization.
Okay, fair enough. And have the companies been successful in deploying that capital in a way that has driven down costs and has innovated?
Well, some of them have, absolutely. But some of the most technical ones, the really sharp guys are still having difficulty at $40 a barrel. EOG has maybe one of the best technical teams in the business in the oil shales. Chesapeake, absolutely crack technical team, and a loyal workforce. And so it's hard to think that the private equity firms can peel off enough of this know-how, especially when the MBAs and the CFAs in New York tend to look at the shale plays as having zero geologic risk. And so they were playing a very different game than a regular oil company, which would be trying to develop sustainable projects and sustainable drilling inventory. One of the producers I know in Oklahoma, very profoundly states, we drilled wells and we were profitable drilling wells until we weren't. And that was 2014.
So we hear a lot about the decline in production rates. For those who don't follow the story, shale wells require a lot of capital. You've got to drill because they have such severe decline rates after 12 or 18 months. You have to keep drilling wells all the time. So the shale basins are real, capital hungry. And one of the problems is that the decline rates are steepening, I guess is the way to put it. And is that what you've been hearing as well?
Yes, there's been, especially on energy finance Twitter, which I commend to everyone, there have been some trackings of wells and production profiles. And as these producers get outside their high-grade areas, in other words, they're A-plus prospects, they go to the A-minus, the B-plus, the B-minus. The production profiles don't look like the earlier wells. And we've seen this with all sorts of companies. So in the Permian, for example, the idea that a well would do 400,000 barrels and then the daughter well would come in and do only 200,000, and the second daughter well would do 150,000. This appears to be occurring in different areas across these basins. We had the terrible example of Alta Mesa, which had this huge scoop stack area that was a SPAC run by the former CEO of Anadarko. They went out with a public offering of $3.8 billion, and then 10 months later had to write that down to $3.1 billion. And then the entirety of the assets was just sold out of bankruptcy for $220 million. So there are a lot of assumptions that have been made by some of the management teams, and many of the investors have kind of followed along.
So what's been the impact on the services economy? We've heard of massive amounts of rigs and equipment being parked, even some of them being cut up for scrap metal. And this is particularly important for Alberta because a number of Alberta drilling companies, as the wells drilled in Western Canada declined, they moved their equipment down to the US, particularly the Permian. and seems like their timing was terrible. They went at exactly the wrong time. So give us your take on the services side.
It's devastating for the services side in the U.S. Halliburton just laid off another round. Baker Hughes is making an announcement today, if they haven't already. Many of the small shops, drilling, logging, this is getting to be really difficult for them. And I'm getting a notice that my internet is unstable, but I don't know how to fix that. So
carry on. We're getting a degraded video image, but that's all right. Your audio is fine.
Oh, okay. It's just going to be extremely difficult for the service side, and I don't think we're going to see the full impact until after we get past the payroll protection payments that have come out of the Treasury, the COVID-19 recession and the bailout, the CARES Act that Congress passed 2 weeks ago. Has allowed many of these companies to go obtain essentially free funding from the federal government as long as they don't lay off more than a certain amount of their workforce. And so we really won't see the full impact for several months, I think, on the services side and on the producer side.
Looking out ahead of maybe the next 3 to 6 months as we have this global recession, with no idea when it's going to end. What is your take? Can you give us a reasonable take on, what impact the global recession might have on the shale producers?
It's going to be awful. We've been building an inventory overhang for the last month and a half of anywhere from 5 to 30 million barrels a day. This is going to postpone or push out any kind of recovery that the oil patch would have, quite apart from the Saudi-Russian price war and supply war. So the answer, no, I don't know.
Okay. Final question, Ed, and then we'll open it up for questions from the group. And that is, I've been hearing that the majors that are in there, the Exxon Mobils, are beginning to expand their acreage, and looks like there'll be some consolidation in the industry. Are you optimistic that as the majors, sort of expand their production, that we might see a more competitive industry because they have the clout, the technology, the capital, and so on to drive down costs where the shale production is economic?
Well, that's what we've been expecting the last couple of years. And so, one of the metrics that I use is Tobin's little Q. A show of hands of everybody who recognizes Tobin's little Q. There we go. One. So that's the ratio of the market value to the replacement value of the asset. And Tobin's little Q since 2014 has been negative. Has been less than 1. So it's been cheaper to buy in the market these assets than to go out and replicate them. And the odd thing is that so many firms were pushing and buying the absolute assets rather than just purchasing them out of the market like they could. Today, we've got, I guess, the entirety of U.S. E&P has a market cap less than Apple. And so there are a lot of bargains in the market right now. We'd expect that those companies that have really sound balance sheets, they're going to go shopping and pick up some really good assets. And hopefully, the current equity holders won't be squeezed out completely. But I also think that we're going to see a challenge with some of these guys who have lenders who really now have full control of the assets. We're going to see a bunch of bankruptcies that had started, but have been on a pretty steady trend for the last 5 years. The Whiting bankruptcy is one that had been rumored and worked on for the last 2 years. So the fact that they went a couple of weeks ago is no big deal. We've got many more in play. The restructuring firms and the bankruptcy law firms in Texas are, well, they're hiring right now.
Okay, let's open it up to some questions. And the first, I'm going to call on Stu Parnell. Stu, you're in the business and know the finance side of this well. What's your take on this?
Well, I think that I think Ed's bang on. I think it's it's a disaster in the shale patch. Light tight oil is it's high cost. You know, he's touched on every single point that that you know that most of the sage analysts have been pointing out for years. Is that the high decline rate coupled with the you know, lack of capital discipline and you know, pumping up the prime acreage and you know, selling it as a stock market story instead of a viable industry at all prices has kind of led us to where we are, right? And there's an over reliance on these numbers, you know, the production levels to create, you know, theoretical energy independence in the United States, when really, you know, it's the continental energy interdependence that matters. And to be truly independent, you have to be able to access energy from multiple locations. And the high cost stuff, you know, it's when it comes off hard. And I think that, you know, the shale patch is kind of kneecapped for the next 2 years at least.
So we're seeing
that's kind of my gut feeling.
Yeah, no, that makes perfect sense to me. So Stu, in terms of what's your take on the likely reduction in production? I'm seeing numbers like from 12 to 9, from 9 million barrels a day fairly shortly. And will that reduction in production achieve what the Russians and the Saudis wanted anyway, which is to get some of that shale production supply out of the global market, and then put a firmer floor, I guess is the way I describe it, under prices. What's your take?
Yeah, I think so. It's going to take a while. You know, if you look at, I guess the light tight oil is about 7.5 million barrels of U.S. production, and you know, half of that was drilled and completed in 2019, and has the you know, kind of the average 50 to 60 decline rate in the first year. So you can see that a lot of that production is going to come off. We've already seen about 300 rigs or so. I guess we're waiting for a Baker Hughes announcement here in an hour or so. But you know, you've seen a massive decline in rig count. So you know, I was kind of I do more back of the napkin, but you know, the reduction is going to be between 2 and 3 million barrels a day by the end of the year. It's not going to be immediate. These things take time, right? But there's a lot of wells being shut in, and Conoco's made their announcement, Canada, Surmont, and also in lower 48. So I think you're going to see these accelerate, but it takes time to get there. And yeah, I think you know, the market will help the U.S. achieve what OPEC plus wanted them to do.
So Ed, question for you: is all of this carnage that we're going to see in the North American, particularly in the U.S. shale basins, but you know, we're seeing some of it in Canada as well, is this really what was necessary to kind of clear out the deadwood and bring the global oil markets back to some sort of, I want to say rational, and I know you're not going to like that, but some sort of sensibility, so there's, you know, stability going forward? To the extent that,
yeah, I think you know, the Saudis are behaving very rationally as a competitor in the global oil market. You know, they had been part of the cartel. They were carrying the water for the cartel, if you will, for the last couple of 3 years. It was just going to stay that way. They got tired of it. You know, the reason the oil price kind of stayed up and OPEC kind of said, well, we're adhering to these cuts, that's because Venezuelan production was down, and because Libya was basically knocked out of the market with a shooting war. The Saudis producing about 9 million when they've got a capacity well in excess of that. You know, they had taken dead aim at the U.S. shale plays in 2014. The oil minister said, yeah, we'll just let the guys who are capable of doing it get in there. And we're having a little group group chat here, the U.S. is a net exporter. That's just not right. The U.S. produces 13, our top production, 13 odd million barrels a day. We consume about 21 million barrels a day. So how did we get to be a net exporter on that math?
Right, and fair enough. But isn't there also an issue of grade? Because I've heard that, you know, gasoline demand is has plateaued and has been plateaued for a while in the U.S. And of course, that's what the light sweet crude, especially in North Dakota, but even in the Permian, that's what it goes to make is gasoline. And there's no more need for more light sweet crude in the U.S. and that's why it's been exported. What's your take?
Absolutely right. You know, and you know, we went through the hearing on Tuesday with the Railroad Commission. How many were there? Anybody hands? All 10 hours, mind you. And you know, we pushed out light sweet imports maybe about 5 or 6 years ago. But we're still importing 7 or 8 million barrels a day of heavies. That includes, of course, oil from Canada, but from other nations as well. You know, and you know, a lot of people include renewable diesel, biofuels, ethanol, other such liquids, NGLs. You know, those are all good products, but for crude oil, we are just not independent, and we haven't been. And you know, as long as we allow imports and exports, you know, we're never going to be independent of the market.
Ed, I'm curious about if you have an opinion about the heavy market, because we've seen Venezuela. I think it was at 2.1 million barrels a day 3, 4, 5 years ago. Now it's under 400,000. Supply is basically collapsed. Much of its infrastructure is ruined or damaged. Hard to bring that back online. We've seen Mayan is in long-term decline. And so it seems like in the US Gulf Coast in particular, the prospects for Alberta bitumen and heavy crude is actually pretty good and getting better over time.
Yes, I agree with you. You know, to the extent that, and you're very familiar with this, I've been an advocate for returning to oil import quotas for the U.S. I was against lifting the export ban. I you know, have done the economics, the cost benefit, if you will, of the military expansion that we have across the Middle East. Everybody has pointed this out. Eisenhower knew it. Kissinger's written about it. Greenspan writes about it. You know, we've spent the U.S. more than $6 trillion since 9/11 over the Middle East. That's 6,000 dead, 60,000 odd wounded. I mean, we've talked about this, and you know, how many of those 200,000 family members would be happy to clean up a spill in Nebraska if Keystone XL were to have a spill? And so you know, the national direction, this nation really hasn't had a cogent energy policy and a cogent oil policy for decades. But given where we are right now, yeah, the Canadian crude coming in, I think is you know, certainly beneficial. You know, we're looking ahead to you know, moving away from crude. The U.S. is likely to do that faster than some nations for transportation, and you know, we'll have.
Hang on a second. I've got to jump in here. That's something that I'd like to hear you address in more detail. Why you're talking about peak oil demand in the U.S. sooner than elsewhere, and decline in consumption of crude oil faster than elsewhere, if I understand you correctly. What's the argument for that?
Well, you know, number one, we're not going to lose our refineries, so we'll become the toll blender or the toll processor for other nations, which is what we do anyway. We send out a lot of refined products, but my expectation is, you know, for the last 10 years, the political polls have shown that 76% plus, a supermajority, if you will, voters in the United States favor low carbon outcomes, reducing emissions. They argue back and forth about what caused it. Let's get past that and look at what can be done going forward. And so this supermajority, which of course includes Republicans and Democrats, are pushing for cleaner vehicles, cleaner energy usage. Texas, of course, is leading the way with wind energy, and now we've got hundreds of millions of dollars of solar plants that are planned for this year. Eventually, that's going to push into vehicles. Right now, the economics on buying an electric vehicle are far superior to that of buying an internal combustion engine. The only challenge is I can't get one that would allow me to get to Dallas in a single drive, and recharging would be a problem. But for just driving around Houston, day to day, electric vehicles make a heck of a lot of sense. And those folks who own them spend a heck of a lot of lifetime cycle money on maintaining them. And so I think we're going in that direction. We'll get there a lot faster than other nations.
Ed, this is kind of curious. I've spent lots of time in Texas since 2003, and lots of time in Midland and in the Permian. And when Canadians tend to think of Texans, we tend to think of them as, kind of the folks you find in Midland, right? Salt of the earth and, but in fact, Texas is—
Brian is laughing. Are you in Midland, Brian? Okay.
But Texas is actually in many ways an energy progressive place. It's got like 14 to, I think it's either 14 or 20% of its electricity is provided by wind. We're seeing look at all the what you're talking about, solar and so on. And so I guess what I'm getting at here is that the approach to energy in places like Texas are a whole lot moving. The industry is moving a lot quicker than we imagine towards cleaner sources of energy, low emission, low carbon types of energy. Is that a fair observation?
Yeah, so Texas is the technological hub for every form of energy for the most part. Solar facility, I mean, Shell has a $2 billion renewable energy operation, and kind of nobody pays much attention to it. Downstream, truck stops are looking to incorporate more renewable diesel, CNG, LNG, things that can reduce emissions. There's a lot of activity there, but of course, if your business is entirely focused on oil, that's what you're focused on day in, day out.
Exactly right. Well, Ed, we've monopolized your time here for half an hour. We really appreciate that. Does anybody have any other questions for Ed? Put up your hand, please, if you wouldn't mind. Stu, go ahead.
I don't know. Hi, Ed. I don't know if you follow the natural gas market as well as the oil market. Is that part of what you wrap your head around? I just wanted to know if you had a comment on both the reduction in drilling activity in some of the shale gas, but also in the associated gas reductions and what that might mean for the continental market once industrial usage starts to pick up again.
Yeah, I've noticed that gas prices have held fairly firm, but of course they're below $2, but still they've held fairly firm. We've seen a lot of activity drop off in the Marcellus and the Utica. And that's primarily because storage is going to be filled a lot faster over the shoulder season, and also because the warm winter that we've had. On purpose, natural gas production is going to be cut just because money's not running into it. The associated gas into the Permian, the environmentalists who testified at the Railroad Commission were really excited because they were applauding this as the reduction of flaring kicks in. The U.S. still needs more pipes. We love to have pipes into the Northeast. We'd love to have pipes down to Corpus and another one out to California would be great. But I don't see gas really being knocked out as much as oil has. Primarily, it's not a substitute. As long as gas stays below $2, I think we're going to see a very accelerated retirement of the remaining coal fleet across the U.S. And over time, that of course bodes well for natural gas.
Folks, now Ed, you're welcome to stay if you like. Just before we started the Zoffee, the Prime Minister announced a support package for oil and gas that consists of orphan well association, money to clean up orphan wells, which we've had seen before, as well as I think $1.7 billion for other supports. So I'm going to turn, Stu, have you got any insights into what was announced today?
No, because in true federal government fashion, they announced the plan in a press conference and details to follow. And I guess they've done some costing and some thoughts about jobs, right? So the 1.7 billion is supposed to be across Alberta, Saskatchewan, British Columbia. So it's multi-jurisdictional, and that's targeted at orphan well cleanup. So it doesn't say whether that's a loan to like a OWA type organization or whatever, but clearly the funds are meant to flow. And then they have, they've established, I'm just reading this here, a $750 million emission reduction fund with a focus on methane. So I guess, more research for fugitive methane and more money going to that. But, clearly more detail is needed before any proper and cogent commentary is made. But I think as we've discussed, I always felt that this is kind of the way that the aid would flow, aside from wage subsidies and things like that, and maybe some loan guarantees, but that it would flow this way because it ties in with the environmental agenda, even though it is kind of rescuing bad actors from their prior misdeeds and not funding their cleanups properly.
I want to ask you about this, Stu, because last year the Canadian Energy Research Institute put out a study on methane emissions in the Western Canadian natural gas supply chain. And one of the really startling discoveries in that study is that in BC, you make 5 billion cubic feet of gas a day, and the methane emissions are 2.2 megatons a year. In Alberta, you double the production, 10 billion cubic feet a day, but the emissions are 24.5 megatons a year. So you've got, 10 or 11 times the emissions and only double the amount of gas. And the conclusion is that there's a lot more, leaky wells and infrastructure and so on in Alberta than there is in BC, which, up in the Northeast, it's newer, some of it's electrified and so on. And so I find that focus on methane emissions reduction really interesting, and wonder, Stu, if you think that maybe a lot of that might flow into Alberta, because it appears that that's where the problem is.
Well, methane emissions is not an area of expertise that I have, but I think that theoretically that seems like it could. I would imagine that the oil sands and the intensity of natural gas consumption, for oil sands production probably contributes to that, and the network of pipe and everything and all the other gathering and distribution facilities and gas plants that exist to service that market probably contributes to the level of methane, fugitive methane and emissions. So, but aside from that, that's not my bailiwick. So.
Right, but I would also make the observation that the fact that the government is putting that much money into fixing the methane emission leak problem suggests that they have, some serious plans for expansion of natural gas production and LNG probably in the future. I mean, why plug the leaks if you're not committed to the long-term production of natural gas?
Well, you plug the leaks because they're a problem. Right? So I
For
think
sure.
that's the first step, and methane is a much more potent greenhouse gas than CO2. So I think that's consistent with the federal government and meeting obligations under Paris Accord and things like that. So I think that that's kind of underpinning some of the thought process there. But yeah, I mean, obviously, Canada is staking a lot of its energy future on LNG Canada and developing an export industry there. So I would imagine that if you can plug those leaks and manage the methane emissions properly, that helps develop that industry.
Now, Ross, you've been very patiently waiting with your hand up. Floor is yours.
Well, just to comment on that, if you go to Saskatchewan and you look at the methane emissions from Saskatchewan, they're also very high with respect to amount of oil and stuff gas that's produced in that area. And my take on it is, if you're drilling a well for gas production, you have pipelining to it, you have all the product that's pushed out into some sort of refinery, and therefore because of course you're looking at this gas from a revenue source, there's not the amount of leakage you'd think. And of course BC has mostly gas, not as much oil production. As you start moving east into Alberta and certain Saskatchewan, that changes, and it's mostly oil production. But the problem, of course, is that if you have this little stripper well in the middle of nowhere where you can't get a pipeline to it, all you've got is a holding tank on the side. What happens to the gas? You've got to flare it or vent it. So my feeling is that the pattern that we're seeing is very consistent with a gas production as a sidelight of oil, or as a problem on top of oil production.
Just as an aside, Ross, the data for Saskatchewan are 400,000 cubic feet a day and methane emissions of 16.5 megaton a year. So 1/12 the production of Alberta, and way more than half of the emission rate. So yeah, gas in Saskatchewan ain't making green LNG. I think that's a pretty fair takeaway on that. Okay, anybody else want to make a comment, ask a question of Ed or Stu or Ross or any of the other some of the experts we've got here? No? We're all good? Thank you very much, folks. We'll wrap it up for today. I'll put the recording up on our YouTube channel, and if you want to point anybody towards it. Thank you very much, Ed. Really appreciate you taking the time out of your busy day. I know that even though you're stuck in your apartment, you're still busy commenting on the energy affairs of the U.S.
Thanks, Ed.
Gentlemen, my pleasure.
Yeah.
Okay, take care, guys. See you tomorrow.
Yeah. See ya.
Bye-bye.